Welcome to REI Partners. We help everyday people build wealth through real estate. Learn, invest, grow. Follow us to start your journey. Disclaimer. This show is provided solely for informational and educational purposes. It is not financial, investment, legal, or tax advice, nor tailored to your individual circumstances. Laws and regulations may vary and can change at any time. Always consult qualified professionals before making decisions. Presenters, guests, sponsors, and advertisers assume no liability for any losses resulting from reliance on this information. You are solely responsible for your own actions and decisions.
Hey everybody, welcome to REI Partners. Tonight's a pretty special episode. We're talking about credit and credit situations with regard to real estate. So I have with me Dave Burgio from Trifecta Credit Solutions. You want to do a quick intro, Dave?
Yeah, man. Thanks for having me.
Sure.
I appreciate it. My name's Dave Burgio. I am one of the founders and the CEO of Trifecta Credit Solutions in Allentown, Pennsylvania.
And what do you guys do? How'd you get into the business?
Yeah, primarily, how did I get into business? That's interesting. Started off as a curious side hustle about 10 years ago because I saw a need and I felt that people weren't doing it right according to social media stuff. So I just started doing it on the side for lenders that were close friends of mine. And then 5 years ago during COVID, we just decided to kind of go all in and started this brand in the height of COVID from our basements. And here we are today with an office and a team. And we do actually a lot more than just credit these days.
That's awesome. Did you start from a place of need? Was your credit, not to get super personal, but was your credit in a point where you needed help to learn the business, or was it something you had?
Well, at that time, I actually just got out of a bad situation. It was like right around, the crash of 2008. Like if you weren't in real estate, I think it affected you in anything else that you did at the time. Like my job, it was, I worked in basically a sales structure, right? So people aren't buying, you're not making money either. And, had to live on debt for a while and it just got out of control. So I saw the bad side of it, but you take that a step further. I learned as a kid the good side of it. So when I was 18, I had really good credit out the box. I bought my first home and car when I was 20. And then unfortunately, a couple of years after that, I went down the bad side, did some things that I thought were the right thing to do. And then looking back based on Fair Credit Reporting Act laws, other consumer laws and so forth, like I thought I did the right thing, but probably wasted some time and a lot of money not doing the right thing. And it's like, man, this is really valuable and can really help people out. And if you would have asked me 10 years ago if I'd be doing this today, I'd say you're out of your mind. Like
Not everybody's dream to do a credit repair specialist.
Yeah, I guess, but I was always intrigued by it. I remember a sixth grade teacher, and I've told this story a couple times where my parents had really bad credit when I was a kid because of their divorce. Right. So one of the lines I tell people all the time is that credit never discriminates, because my mom, struggling single mother at that point, trying to keep the house that her and my dad built together. I was 8, 9 years old at the time. Mm-hmm. And then my dad building his business started making really good money, but he kind of lived in the hood. And why? Because his credit was bad and he couldn't get at home at that point. So you have somebody whose business is prospering, but doesn't have the credit, lives in one of his rental properties. And my mother, who's struggling and living in the house that they kind of built together, that she's struggling to maintain and doesn't have good credit either. So it's not like she could leave and get something that she could afford. So it's a really unique situation. That teacher at that time saying, hey, get one credit card and pay it off in full. And I said, yeah, it's going to be me when I turned 18. Now, obviously, there's more to it than that, but that was kind of how I got my start. So there was always a strange interest of it. And I think it's because of my parents' issues coming up after their divorce. So it was one of those things where it taught me, hey, I don't want to be like that.
It's easy to fall into a trap if that's what your family's used to. Like you are a subject of your environment. Yeah. And it sounds like you took that and turned it into something that you're giving back to a huge community now. I mean, you guys have a hell of a business that's all over. Yeah. So can you talk about like your reach and what you guys provide, like from a credit perspective?
Yeah, our reach is nationwide, and first and foremost, especially locally, let's not forget about the Lehigh Valley. It's always first and foremost. Do we have that ability nationwide? Yeah, absolutely. Currently, our client list right now active just on the credit side, it's in 14 states. So, but home is always where the heart is, man. So like we always want to help out here first. in credit, it's always education first, right? Somebody comes to us, it's not just full blown, all right, let's go. It's no, what's the problem? What problem are you trying to solve? And most of the time that problem, it's never just, well, I want good credit. You know, people don't wake up and they're like, you know, from the next day, it's like, you know, I'm going to have a really good day today. What am I going to do? I think I'm just going to fix my credit just because.
Yeah.
Right. It's right. It's always, you know what? I think I want to go try to buy a home. I have no idea what I'm doing, where to start. I want to go buy a home. Hey, you know what? Maybe I want to go to that brand new car dealership and treat myself to a new car. You know, I have no idea what I'm doing, but I'll go do it. And now you're seeing this thing even, as we were joking a little bit before we started here, like solar too, right? Because it's like, you know what? Maybe or maybe not, depending on how you look at it. I want to save on my utility bills. How do I buy solar? Well, you need good credit for that too, you know? So, but it's always educating on those different parameters based on what that goal is first and foremost. Then let's look at a report. Let's educate you based on your report, and not only touch on the negative. I think the whole industry is worried about the negative items, when more or less 65% of that is, hey, what are you doing positive? What does the rest of your profile look like? Because that's what's really going to impact you and pull you up.
And the sooner you learn that stuff, the better your end product could be. And especially in the beginning with education, you mentioned that's the foundation for everything. You know, school, to learning a new job, to learning all that. That's why we focus so much on real estate education, because it's very comparable and you need credit in most cases to do that. But starting from the very beginning, the education is important. It sounds like you guys provide a good, stable or environment for that in multiple different ways.
Yeah, because a lot of people don't understand it's I say the three main things out of the 5 things that make up a credit score. Pretty much 4 of them, but 3, like, you really control your controllables. It's controlling your own destiny, so to speak. It's very simple when you break it down. A lot of people, I think, overthink it and they think it's just complex. And that is because of the lack of education. And keep it in mind, like, you're not going to convince me otherwise. That's by design,
right?
Like, you know, there's a good saying out there to the banks or all these financial institutions, your debt is their asset. Like, there's a reason for that, right? Oh, you have bad credit? Cool. We can make more money off you.
Banks are not your friend.
No,
they're not here to.
They're there to make money, man.
Right. And they actually make more money when you default.
Yep.
Just like foreclosure, car repossession, it never is a, dollar for a car. There's always leverage there. And that leverage, Ramsey's onto something. You're at the mercy of your lender, and the lender's always in charge. So it's no different with credit. You need to have credit to get a loan to do anything, whether it's a car or real estate or a business.
Yeah.
It's huge.
And everything with that, it's designed for them to win. Like, okay, how am I going to win in the end? Like, you can win too, right? But I come first, right? So if you lose, I'm still going to win. It's crazy to think about it that way.
What do you think of when we talk about things, we try and relate it mostly to real estate. So in the purchase of a property, whether it be a single family house or a 10-unit office building, we always hear this term, cash is king, because you control a lot. But that's not always the case when you're trying to buy something, unless you got a few $1,000,000 in the bank, which some people do, but pretty much nobody that we're talking to does. What do you suggest, that word cash is king, and how do you apply that to your credit?
I mean, I used to believe cash is king until you learn how to leverage credit properly, right? Credit has a negative connotation across the board. If you look at like the 70s or 80s, right? Like when credit cards were really starting to evolve, people that had a lot of money had credit cards, and then the market changed, the banks changed. They understood, hey, we can really profit on unsecured debt and what we can charge on these interest rates. So now let's market the buy now, pay later, right? So then that's where it became this vision of, oh, hey, well, if we can't afford it, let's buy it anyway, right? So credit always had this, and look at today. I think the last time that I checked, I think in the fourth quarter, because they didn't have Q1 yet, but the fourth quarter, something crazy, like $1.3 trillion in credit card debt.
That's it.
Yeah, that's it. Huh? Like how doesn't that like implode? Like it just like collapse. Like it's bound to happen. Like you can't run that house of cards forever.
It's been a system of false supporting. It's no different than the federal government and currency, how it's just diluted and diluted. Eventually, you mentioned the house of cards, that's real.
Yep.
With not just credit cards, but over leveraged homes, over leveraged cars. How many people do you know buy a car, want a new one, so they roll that balance into the new one, and then they go in, over their head. They owe more than the car's worth, but it's okay. We'll finance the difference in the new car. How much do you need your payment to be?
That's it. That's what it's marketed on.
Not how much debt do you want to take on. This society, and please feel free to interrupt me if I'm misinterpreting
you're
this.
Probably on the right.
But the society where it's instant gratification,
Yep.
you can finance pretty much anything, including, I saw Grubhub. You can finance a meal to your door now, which is ridiculous because you're encouraging this instant gratification, and this allows you to do things, but it also encourages very poor decision making for people that don't have the education, like you brought up in the beginning.
Yeah. I think I saw I was looking for a new pair of shoes on Nike.com the other day on the app, and it said you can make 4 payments for $50. For $50. Are you kidding me? Like, if you can't afford it, and listen, understand, there's people out there that struggle, but if you can't afford $50 shoes, then you shouldn't even be buying them. It's just, I was just looking around. I said, let me see what's on sale. And I saw these shoes for $50. Let me check them out. 4 payments. We've got to that point now. Like, it's just, I don't know, man. It's almost things like that. It just kills everything. It's like, oh, credit's bad. I defaulted on a pair of Nikes. They're going to repo my Nikes.
Do you see a scenario where you can take that same opportunity to buy a Nike shoe with credit and leverage and turn it into something that makes you money, like a rental property? Because leverage, it goes both ways. You can buy a pair of Nikes that are going to be old in a year, or you can buy a house that's going to pay you, or a rental that's going to offset your tax liability in some way.
Yeah.
So what are some ways that you see people using leverage and credit in real estate?
Well, yeah, and they even go back when you were saying, cash is king and all that stuff. I mean, leverage your good credit. I mean, if you saved all this money, right? And, obviously Nikes, unless, let's not get crazy here. And, I'm not a sneakerhead, but all Jordans, they're going to make money. It's like, yeah, well, they might make a couple $100. They're not going to make thousands of dollars. Or if you really, hone into what you guys teach, possibly if you put in the work, millions of dollars, right? You got to have a lot of Jordans to get to that point, at some point in time. But ask, and, I don't know if this is true. I'm sure mostly it is. Ask any real estate investor or anybody that got in, chances are, hey, they leverage some type of debt to get there, because if you stack or try to save money, and I'm a big proponent of time, everything based on what we do, even on credit, even in a credit analysis, a credit report, everything's based on time. It's how quick can we turn it around? Well, how quick do you want to get a piece of real estate? Do you want to wait 10, 20 years to save a couple $100,000 to play with? Or if you do have that money, why would you spend all of it? If I can borrow, 80%, 70% and use this money down. Well, now this pile of down money I have, instead of getting one property, I might be able to get 5 or 6 in one shot. So it's a multiplier effect. Credit creates a multiplier if you know how to leverage it properly.
Do you see, there's a lot of people that we'll go back to the Ramsey thing where you buy everything cash because you don't want that chain of a lender. Those people that choose to do that, which is, very smart for some people that might not have any money control or maybe abuse credit or something like that. I totally get it. Living out of an envelope for your cash for that day, it teaches very good responsibility. But those people at some point in their life still need credit. And if you are cash from day one, what happens to your credit if you never use it? Like if you never generate it from day one?
Well, you don't have any.
Okay.
And it's just as bad as, it's just as, I don't want to say it's as bad. It's kind of like the draw, right? Like you tie in a football game. It's, we didn't lose or we didn't win either, right? It's like a draw. So, but it's as bad as bad credit, but it's sometimes easier to start with that fresh slate so you can grow pretty quickly because you don't have any other negative items on there, if you had any other negative items on there. So that way you're ahead of the game. It's if you can open up either an authorized user account or even better yet, get something in your name like, secured credit card, you'd probably be at least in the high 6s already just from one trade line, and probably after 90 days being the 700s just from 3 months of age. So, yeah, you have no credit. And I know people like that. Actually, when I was doing this in a side hustle, I used to just work closely with my friends, or people that I knew were looking for homes at that time. That's how we got our start in credit, really, is mostly people coming in getting FHA loans. We were getting them approved for that. So we had a lot of experience on getting people approved for some type of real estate. And a friend of mine was like, hey man, I just need my credit fixed. And when I looked at it, it was probably one of the first 5 actual repairs I ever did. And I'm looking at it, I said, hey, you got a lot of like stupid like medical debt on here, like dumb stuff. He's like, yeah. I was like, well, you got a Jeep. And here's going back to your example. I said, you just got this Jeep not too long. I paid for it in cash. I was like, okay. I was like, well, your credit's bad. I can see why you paid for it in cash. But I was like, you rent, so no home. So you don't have any credit cards? He's like, nah. And I'm like, man, you got like a 500 credit score with like 5 or 6 collections. I was like, that's pretty interesting. Like, this is like the first time, this is like almost 10 years ago working on this. And so I said, the last person I worked on, I said, really good success on removing medical bills. And today, yeah, there's a lot of reasons why, like laws and so forth for that. So when I worked on his first time, boom, got them all wiped out. He said, hey man, this is awesome. You got all this medical debt removed. I said, cool. I said, what's your score? He's like, I don't have one. I was like, oh, okay. So you went from 500 to 0. But it's like, hey, now like you got to build. Like, and I tell people that all the time, because it's the bad thing about credit repair too, like not credit coaching or credit consulting, because credit repair is tied to, hey, getting rid of items. That's where it's marketed. And that's where kind of, when we came in the industry, it's teaching the right things. It's not all about getting rid of negative items. I tell people all the time, I said, look, if you have a pile of just crap on your credit report, and saying it perfect, because you're not going to get everything removed, right? You could get a lot removed, but you're not going to get everything. But say in a perfect world, I got everything removed. What are you going to be left with? Nothing.
Nothing good.
Exactly. Well, nothing at all. So and that isn't good either. So you have to understand that. And this is where I was saying the positive, right? The positive is 65%, the negative, that's the 35%.
So starting off with people that might have a bunch of negative on their credit report, whether it's things they choose to have like Nikes, or things they don't choose to have like medical bills, you got to approach them all with the same intent, but not forgetting the positive. Because if you go to leverage yourself for any way, just to get a small card to improve your credit or to buy a house, you're going to have to answer those questions before you can actually go through with that. So if you have a person who's looking to buy their first property, and let's say they have credit scores in the high 500s because of whatever happened in the past, what would be your suggestion to get that up a little bit? Because we know if you're buying primary residence, it has to be at least in the high 6s at a minimum for a mortgage company traditionally to touch them. What's some suggestions you have?
Well, usually the lower the score, and people might look at me weird when I say this, because again, I touched on controlling the controllables before, didn't get too in depth. So obviously 3 main controllables: pay everything on time, keep your revolving trade lines, or AKA your credit cards, either as low or no usage as possible. And then make sure you get a new mixture every once in a while of revolving installment loans and a mortgage type loan on your credit report. Not saying you have to, but that will maximize your score. But anytime somebody comes with a score, the lower the score, I actually get really excited. And they're like, dude, what's wrong with you? Like, I'm in like the high 4s or low 5s and you're excited. I said, yeah, because that tells me already that I can show you how, right? I don't like using the word guarantee, but I can almost guarantee, right? Legal purposes and disclaimer stuff, but that I can show you how to get 100 points right away on the rip. Because if you're that low, that tells me either if you do have open credit cards, right? Because revolving lines are 30% of your credit score. So they're either you have none or they're all maxed out, right? And it's by the percentage. It's not by what you owe. So if you have $1,000 in credit limits, but you're at 100% usage, that's better than having 100,000 in credit limits and being at 100%. Now you're in serious trouble. But if you're maxed out at, say, $1,000, it's, hey, how quickly, my first question would be, how quickly can you get this $1,000 to close to 100, to owing 100? I could probably do it in the next 60 days. Okay, great. Here's why. The moment you go from 100% down to 10, you're probably going to gain at least 100 points back, probably more.
Just by percentage.
just by percentage.
That's crazy.
Well, that's a fact, right? I say 100 because that's very conservative, because that revolving trade lines are worth 165 points, right? Like if you're that 0 to 10%, you're gaining max points. So it's like, look, you pay that down, you will gain 100 points just in the math. The numbers don't lie. Okay. So pay it down. Now, if you don't have anything, right? That's might even be a better scenario, because it's like, hey, you don't have any credit cards. Well, is that a good thing? No, it's not. It's 30% of your credit score. Go get a $200 or $300 secured credit card now. You got $200? Yeah, go get it. Or unless you have a family member that you could be an authorized user on, basically piggyback that lifetime data of that card, how old it is, its credit limit, its payment history, its current usage. If it's 10 years old, you will get the entire 10 years back history of that. If you can get that, go ahead, because that's better and it's free. Right. So it will generate something really cool. It'll probably generate something really good just based on the age. But if you can't, go invest $200 into a secure credit card, and in the next 30 days, you're going to gain some points just from that.
Wow. Every little bit helps.
Yeah. It's the educational standpoint. It's like, because people get tied into the removal. The moment I tell them that, to be like, hey, you guarantee removals? I don't guarantee removals. I don't even like using the word guarantee. I will, as long as you run the play, you're going to have better credit.
Yeah.
Say no removals. Just do some of these tweaks. We actually have an action plan system in our program that, based in real time on somebody's credit report, it will give anywhere from 3 to 10 action steps for that particular 30 days. New credit report comes out, readjust the action plan again, right? We have our work to do. You have your work to do. So there's no gray area. There's no questions. And it's also based on whatever your goal is. Well, I want to buy real estate. Okay. We'll put it for real estate configuration. I want to start a business. Okay. We'll put it in for starting a business configuration. Or I just want good credit. Okay. We'll put it in that configuration, and step by step to get there.
And then you tweak it over time to
every 30 days. Yeah.
Wow.
Yeah.
That's crazy.
Yeah.
I think we have a question from the audience here.
Awesome.
Really quick.
So we actually had two questions. The first was if we could explain the difference between a hard inquiry and a soft pull of the credit.
Sure. Yes. Soft inquiry. I mean, that's just anything that you're just checking, right? That you're looking up. It could be credit monitoring system, credit score on a bank app. Even lenders now are just doing soft inquiries just to see what is on the surface level, because a lot of people don't know. And that inquiry, a hard inquiry, right? That means you're going through the deep dive, meaning you're going to go through some underwriting process to get approved, whether that's a credit card, some type of mortgage, auto loan, it doesn't matter. Anything, you're going to get that deal done. Like, it's going to be the whole picture. And it's not just the 3 bureaus. They'll look up other data companies as well. LexisNexis, they can look up Pacer, right? Which is the core reporting system, to see if you have any judgments or liens or bankruptcies on there as well. So the hard inquiry, the easiest way to explain it for me, that means you're looking to acquire something. So they're doing that deep dive. Soft pull, that's just on the surface, just to take a look at it. Hard inquiries, you'll lose a couple points always initially, which I find is weird, because that's part of a FICO makeup is acquiring new credit products, right? But you're going to lose points off the rip, which I don't understand the math behind it, but usually it rebalances itself after 60 days. And obviously the good thing is, if you get approved, once that new account's on there, starts generating some age, some payment history, your score is going to go up. You're going to have that mixture in that FICO score. And a soft inquiry, it's really nothing. It doesn't do anything to your score or anything. It's just a way to check.
On that subject, can you give a little bit of explanation to when someone's not wanting to apply because of that ding? There's, from what I'm told, there's a time frame in which that ding, you could do as many as you need to in this time frame, and it only counts as one. Or can you kind of explain that process?
Yeah, I guess every underwriter is different and every company is different. You know, there are some credit card companies with unwritten rules. I won't get into name specifics, but there's one major credit card company that does, they say they don't do it, but it's proven to be true that if you have 5 inquiries within the 2-year period, so inquiries will stay on your credit report for 2 years. If you do nothing about it, they'll just fall off automatically. But if that company sees more than 5 over a 24-month period, they'll decline you even with great credit. So that's one of their, I'll tell you off the mic, just in case. They'll do that. There are other companies that they'll look at it and it's like, hey, you just got 3 in the last 3 months. Yeah, you look too risky. We're not going to do it. Everybody has their different rules. Like when it comes to inquiries, it's a risk assessment, right? So if a bank or underwriting's looking at, how many inquiries you have, they're looking at, well, hey, if this guy did so many in a short period of time, like, yeah, you might have great credit, but what's he doing? Like all these credit pulls look a little risky, So like I always say, it's space them out, right? Just to be safe. If you are going to apply for something, try to do it in one shot in like one day. So if you want to get 3 or 4 right away, they might ding on different credit. Most of the time, they're not going to go on all 3 bureaus unless it's a mortgage. Mortgages will always do all 3. Some cards might do 2, but most of the time they do 1. You don't really know which one they're going to do unless you do a deep dive. I mean, some companies stick strictly with Experian, some strictly with TransUnion. But a lot of times they'll change up because they don't want you to pick up on it either,
right?
But they'll hit out on the credit bureaus for that inquiry.
So the mortgage companies, though, they typically, when we talk with clients or when we do it as well, you can hit 2 or 3 different mortgage companies because your terms might vary a lot.
Yep.
Or if you go with one local lender, they might only just pick one. So what do you suggest for someone looking at a mortgage? What would the procedure be for minimizing the impact of the credit inquiries on your overall picture?
Well, if the inquiries become problematic if you don't have the accounts, that's where you want to make the attempt or have somebody like us clean them up. There's a right way to go about it. You just don't say, hey, this is fraud. Like you're going to raise red flags,
right.
But if you really look at it and said, hey, like I didn't authorize, I'll give you a great example. Going to an auto dealership, right? A lot of dealerships to this day, and you sign for it, right? Whether or not you want to admit it, it's on the fine print when you're signing to have the finance department run your credit for in-house financing. But what that little fine print tells that nobody reads, they're going to shop you around for the best financing. So they've gotten better, a lot of these dealerships, but a lot of them still do it to this day to where they'll pull 5 or 6 banks all at once. And you might get approved at all 5 or 6 banks, but they're only going to take one. So now all of a sudden you had great credit coming in. You just, got a lease they don't do it in leases. They only do it in buying. But say you came in, you had great credit. You just bought this car. Now you're coming out with a brand new car. Now all of a sudden you lost 130 points. What? How did I lose 130 points? They just said I'm approved for all this. And it's like, yeah, you just got 6 inquiries off the bat, but only 1 account. So obviously there's a little gray area with that. Hey, I didn't approve all these companies. Like this is the only one I'm doing business with. And typically you can get those removed off.
That's good to know.
Yeah.
I had a scenario when I was first getting into real estate that I had real estate debt, which is a good debt as long as you pay it on time,
right?
Especially if you're going to acquire more. But one of the things I learned was there was a cap in my credit score. It wasn't going any higher. I couldn't get it. And I talked to someone and I said, you need more debt. Like you need more good debt. Mm-hmm. What does that mean?
So here's what that means. Like I said this the other day on a live stream that we were doing. I always recommend get anything that you could get. It's the old firearm adage, right? It's better to have the gun and not need it than to need it and not have it. Credit's the same. And this is why I always go back to credit cards, because credit cards are the foundation of every credit score. I don't care if you're going for real estate, auto, it doesn't matter. Credit cards are everything. I always recommend you get at least 5 credit cards. I know somebody with 67 credit cards, and it's crazy to think about, but it's okay. They're not used. Most of them have no usage on them. They get rotated out, they keep open. He has his own system. It's like 7 figures total worth of credit cards, but you're also giving yourself a buffer at that same point. It's, hey, this guy can really manage it. But yeah, with the more open trade lines you have that are in good standing, and as long as obviously your debt to income ratio makes sense with all that stuff too. You don't want 10 cars on there and you're scraping to get by, because cars are worthless on the bank's eyes. Like you said, real estate, that's a great asset, right? Cars, no, not so much.
That's a good point you bring up. Like, the credit scores affect your ability to get different types of assets. If you get a car, that's different. It's a lot less liability, or a lot less liability to the bank, to your overall picture, versus a house or a rental property that might be a bigger number, but they see that as a good version of debt. Does your credit score position, and we're talking about owner occupants, if you're buying it as a commercial or as an investor where it's a asset-based lending, that does not apply here, because your credit doesn't really play into that.
Right.
You can get that with no credit,
right,
depending on the asset. But how does your credit score affect your ability in the loan terms to get that loan for like a first-time home buyer?
Actually, and this is the beauty of us starting like with first-time home buyers or FHA programs, because like you said, like we said earlier, the bank's always going to win, right? So that FHA program is designed for the bank to win, but it looks good on paper. It looks great on paper for the buyer, right? Yep. It's better than an apartment. You're going to save money on rent. And lo and behold, like, believe it or not, like, I still have the FHA on my house from 10 years ago because the interest rate was so good. But I came in with a lot more money than the typical person would, because it didn't make sense for me to buy a conventional loan at the time. It's like, this is a great deal. I'm in a better position than the seller, so I'm going to take the FHA. And now you look at what happened to real estate over the last 10 years. You know, I don't know if we'll ever see rates like I still have a 3% rate, right, for an FHA. Like, I don't know if we'll ever see that in the next.
Don't expect it.
20 years.
I wouldn't.
Well, I've tried to refinance into a conventional loan, and the math didn't make sense. Like, it just didn't. Every lender I talked to, like, I just had them look at, hey man, does this make sense for me? Nope. Keep it. Okay. Now it's like, yeah, I know the rates are too high, but like, what if I did a little bit of cash out because of equity? Not much, but no, still going to be like $500 a month more. I said, the math just doesn't math. Even if I extended a little bit, I said, that's crazy. The numbers don't lie. But no, FHAs, I mean, yeah, it plays a big role. The thing about an FHA, and a lot of people don't know this is why I love, like, even from a real estate investor standpoint, you know, because you could, according to my knowledge, at least the last time I looked at it, you could still do an FHA and owner occupied, right?
1 to 4 units.
There you go.
Yep.
Right. So still to this day, 580 credit score on the low end, which you're going to pay for it in interest. You'll probably get an extra point of interest, but the threshold and beyond is 620. So 620, 700, 750. It's that 620 is treated the same as that. So once you get to that 620 threshold, you're golden. As long as your debt to income ratio, I think it's still, what is it?
70-30, or no more than 30% in housing.
Yeah, typically. I think it's still that. So yeah, so you could come in like with a low barrier of entry, like 5% down, and yeah, there you go. You know, that is how we started, because we had a lot of renters at the time and people that, you know, just wanted to get in and they could afford it and it made sense. And it's pretty much how our company started, just getting people approved for FHAs.
So although you might not have great credit, you could, in theory, buy your own property if the conditions are right. The bank is obviously going to assign terms, whether it be points or higher interest rates or something like that. PMI is huge. Private mortgage insurance. That's essentially a fee that they built in as an extra profit center for the bank to be your risk.
Yeah, you're paying an insurance policy on yourself if you mess up. That goes to the bank, so they get paid on that, and they take your house. So they're like double dipping. Yep. You want to talk about a big win for the bank? That's a big win, man.
So, and PMI goes away when you have at least 20% equity in the house if you call them.
Not my bank.
Not your bank.
No,
many do.
I tried doing it, and they want me, and this is why I've been trying to get out of conventional, because, and it's like, I'll only do it if it makes sense. But my company won't let me get rid of the PMI. They're making me refinance it. I don't know. Should I call them out?
I would. Honestly, I've never heard of that before.
Serve Bank.
Yeah. Everybody, search that up. Let's help Dave out. Serve. How do you spell it? No, I'm just kidding. But seriously, I would look into it. Get served. They might have to, because it's a percentage LTV, and if your property is, and it's a simple, go put a HELOC on it, and you'll have a value, like a market assigned value. I would look into it, because that could be huge. PMI on a big house or whatever the loan is could be a few $100 a month.
Yeah, I mean, I attempted it probably about 18 months ago was the last time, and the equity in my neighborhood is just insane. And there's a house for sale across the street from me that is literally double what I paid for my house 10 years ago. And I owe, ironically, because if we've accelerated our home, I'm right around under 6 figures of what I owe. So there's more than 20% there.
You definitely look into it. Without getting into the nitty gritty.
You hear me?
So credit score does affect your ability to get the mortgage and the different types. You mentioned FHA, but there's a few other loan programs that you could with varying credit scores. One that comes to mind is VA. If you know anybody with military service, I know you have a lot of people in that space. I was speaking to a VA buyer the other day, the guy's in the Army, and you could get a 0 down VA loan.
Yeah.
But remember, that VA bank is not your friend.
No.
They're a bank sponsored by the government, which is like sometimes a double negative. Like there's all these whacks against you, and the bank is there to make money.
Sounds like a student loan problem.
Right? Exactly. So you buy a house, and don't get this misconstrued with these people of all people need this financing. You know, they've served the country. They have all this background.
They deserve it. They earned it.
100%. But the bank is going to make more money on them than a traditional mortgage, because they're making more interest up front. But that's the cost of not having any money down.
Right.
So it's like, do you really need that house? Or maybe can you buy a less expensive house and have a bigger down payment, more equity? So that's a good point. Do you have any other suggestions on the credit score as it applies to the mortgage application?
I mean, the good thing, I've always said it's easier to get real estate than anything else. And this is to investors, and especially even those that rent already, because again, that property is an asset. It's a growing asset, right? It's not depreciating, it's appreciating 99% of the time, right? So there's a vested interest of the bank. And most of the time, if your credit, even for a conventional loan, if you're 660, 670 or above, they'll do it, even low down money then 5%, sometimes 10%. And one thing I always suggest, if you're going to go conventional route, and if your credit's a little shaky, even 650 or lower, you might have to come to the table with more money, So if there's always that stuff, to me, just from over the years of doing this, just even getting just somebody with shaky credit in, it's always one of those negotiating things, as long as the numbers make sense for the bank. And if you can do it, like, they'll do it, but again, we're not talking about bad credit here. Yeah. You want to be in the 700s. You want that buffer really good. If everybody talks about 800s, I mean, it's really no different than 740, 760, but that's a buffer that I call for credit cards. So again, that percentage that we were talking about earlier, say I had 100,000 in credit cards, I have a 45 out of 850 credit score. And, I needed to swipe something on a credit card right away for $40,000. Some wild catastrophe happened. Boop, swipe, done. Well, now 40% of my credit score isn't going to kill me, right? Like, say I lost 100 points. Well, my credit score is still going to be 745.
Right.
So you get that kind of buffer there a little bit if you need it. So that's really, like, everybody talks about, oh, it's a flex 800. It's like, listen, man, you're not that special. That's just duration and time and good habits. It's really a buffer, because it's all treated the same.
So with primary residence and owner-occupied houses, it's a little bit different. If you're buying a house to live in, even like a 1 to 4, if you're going to live in one and rent out the other's house hack, it's a little bit different approach than if you were to buy it just as a straight investment. If you buy it as a straight investment, there's other tactics that you're going to have as part of your business. And this is something we advise people all the time on. When you're an investor, the numbers work differently with a house, which means your application process is different. The bank's underwriting of the deal is going to be different. So if you have an investor who's looking to buy a 2 unit, for example, and the bank says you need to put at least 20% down. That person is going to have good credit, even if they're buying in an LLC, because they're going to have to personally guarantee the loan. It doesn't get to the point of business credit until you go through a bunch of different hoops. Can you talk about business credit and how that differs from personal credit?
Yeah, business credit, they kind of go hand in hand. And a lot of people, don't necessarily understand that, or again, there's a lot of wild information online where it's, hey, it's all business credit, keep this separate from your personal and you're going to get approved EIN only. Are there things out there that do that? Yeah, corporate credit stuff, or there's very few, there's Wex Gas and Sam's Club Business. They'll do EIN number. I think they're the only two credit cards left that will do that, unless, and if you're getting a corporate card status, you're raking it. You either have a 10-year track record, 20, 30 years like in business, or you're probably doing consistently 7-8 figures of revenue a year and have at least personally guarantor some process, right? Some type of funding to even get to that point, but all in all, you still need good personal credit to coincide with your business. You're still going to have to personal guarantor. These are things that we've been educating business owners per se, because even real estate investing, it's a business. You should be treating it like a business, right? You should have some type of entity, whether that's LLC or, some type of corporation, right? Like have it legally structured, an EIN number. You can build a business credit profile off that. If you're flipping, even if you're holding your buying, or I shouldn't say buying, putting together a big portfolio like that, treat it like a business. There's tax incentives obviously with that too, and you're capped out after a while just doing all this stuff on your personal.
You have to treat it like a business.
Yeah.
That's what everything real estate is, a business. Whether you're living in the house or not, there's income, there's expenses, whether you're renting it or not. And that's why there's this myth that you can just start a business, and it's like it doesn't even exist to affect your person. Your business is an extension of you. Even though there might be an LLC or a corporate veil there, you're probably going to have to fund or put your arm on the line for everything the business does.
Oh, yeah.
So starting off with business credit is good, but it's going to be an extension of your person until you get up and going.
Yeah. And it helps. Don't get me wrong. Like there's a lot of pros to that as well, especially with credit cards. Again, the whole credit cards, they could beat it like a dead horse. I mean, that's a big foundation on a business too. And a lot of people don't know, even if you have a quote unquote business, a legal entity, usually after 60 or 90 days, you should have a DUNS number already from Dun & Bradstreet, right? So that's on their radar to build business credit or a business credit profile. Should be listed on Experian, on Equifax, on the Small Business Exchange. Credit Safe should have it too. You can build credit on that, but again, you still need good personal. Meaning, if you have XYZ LLC, rental property LLC, right? You're building business credit 60, 90 days, even though you have no revenue yet, but you have great personal credit. These credit card companies love startups per se, right? If you have great credit coming in, hey, I want to get an Amex Platinum card for the business or an Amex Gold card. Great. What's your personal credit look like? Well, this is what it looks like. I got an EIN number right here. What's your revenue? I don't have any revenue yet. Okay, put 0. What did you make? Oh, I made $100,000 last year. Okay, great. Put it down. By the way, what is your projected revenue you think year one? I don't know. It might have $500,000 in assets of real estate. Okay, put it down, right? They'll call the concierge. They'll tell you that. They will. Why? Because I've done it before.
Yep.
Right? Oh, hey, here you go. Approved. Open-ended credit limit. Here you go. Now you can start using it. The beauty of the credit cards, just on the business side, there's maybe less than a handful that don't do it, but the rest of them, they don't report to your personal credit report unless you default or unless you're habitually late, depending on what their terms and conditions are.
That's huge.
Yeah, but
absolutely huge.
It's absolutely huge to get it on there. And that's per LLC, right? So I have a friend, when he did his real estate portfolio, he did it by city. So he had an LLC for Easton, he had an LLC for Bethlehem, he had an LLC for Allentown. That's 3 different business credit profiles right there for different things. It's good for an accounting purposes. It's good just to keep it off your personal credit. And now you're creating an extension. If you really want to build business credit, how that helps is, okay, well, that shows on the business side, they're doing revenue. They have different trade lines here for maybe some net 30s, business credit cards. So that can actually help you. Yes, you're still going to personal guarantor, but it's like, hey, this company's done some revenue. They've paid back on their terms and conditions. Yeah, instead of us giving them $50,000 line of credit, maybe we'll offer them $300,000, see if they'll take it. So it does help, right? But it's not the end all be all. It's a combination of both.
One of the things that I'm hearing, and this is kind of like a summary of pretty much everything, is credit is almost necessary unless you're going to buy everything cash. But in order to get there, you have to build up a reputation through your credit profile, whether it's yourself, your business, or both. But the one thing that we haven't talked about, I think is the most important, is you can't be stupid with this stuff. You have to know what you can afford. Like, you can't go out and buy that brand new Mustang that you wanted your whole life because it happens to be on cars.com in Chicago, right? You can't just go buy it and bring it home unless you can afford it with random stuff. And that might have been a dig to somebody.
I was going to say,
right? It was a little bit direct. But no, that person in particular were very, very hard to get that. And assets paid for that, not credit, not anything, straight up cash that was generated from businesses. So to get back to that, if you have the ability to take a credit and turn it into something that's productive, that is a great tool.
Yeah.
But if you are going to take credit and buy just something that is going to waste money, whether it be a TV, I don't want to say Nikes because you might need shoes, but like a vacation, you're wasting your own ability to do something good with it.
I think you were reading my mind. Because when I speak about a lot of this stuff, hey, credit is great, right? Use it to do something that produces revenue, even if it's a little bit of a risk, even if you can't repay it back full. Have a plan, because we know the plan's not going to go 100% the way it is. But as long as you stay consistent and run the plan, yeah, take that risk, right? And then I always say in this, I said, yeah, don't use it to buy TVs and Jordans. You literally read in my mind because I say, buy something that pays you. Don't buy TVs and Jordans. It's not smart.
Like, the value of experiences is more important than the value of stuff. Mm-hmm. But if you have to finance a trip to Disney,
no,
you might not want to do that because it's going to live with you a lot longer than those pictures will. Mm-hmm. And if you default because you can't afford it, we see this a lot, unfortunately. People make knee-jerk reactions, or sometimes they're put in a position through illness or whatever to have to use that credit and then they can't repay it. Just be responsible and know your limits and don't open credit lines that you can't have. Mm-hmm. For young kids, if you can get on a credit profile early to build up that credit while they're younger, that's great. But as soon as they're out of the house with their keys, what happens, right? They're going to be out there rogue, hopefully making good choices.
Yeah.
So, making good choices is the absolute overarching theme of this whole thing, I would think. Credit's great, but only control.
But things do happen, like you said, medical debt, divorce, right? Yep. Like that's not cheap. I can't tell you how many, there are some dumb stories out there. Like, what are you thinking? But then there's also some really sympathetic stories too, divorce, a death of a spouse. Like that's heartbreaking. A kid gets sick. Like that's the worst, man. And it's hard to deal with, because we all have that, we're married, we have kids, so you sympathize with that, but it's also, you have to step back and paint the reality. Like, look, this happened. But also the good thing is all this is temporary, right? And that's one thing I tell people about credit. Like, that doesn't make or give you an excuse to be reckless and stupid. Right? Because it can cloud you for some time, right? But just know there's a right way to get out of it, and you can get out of it and rebuild it. Look, man, like, my story's perfect. Learn from my parents. I had great credit out the box. Mm-hmm. An economy problem that affected a lot of people beat me down. I came back and, here again, so it's just, it's a never, don't repeat the cycle. Right? You get a lot of people, like, if you're repeating a cycle, and we do have repeat clients, which is a terrible thing to say, it's good for business, but like, that's not how you want to live your life in that trap all the time. But like, if you're a repeat offender, then, you have a serious problem with that. Maybe they should ban you permanently. I don't know.
I have a few closing, just brief questions.
Sure.
If you give some advice, brief points to our audience and the people that kind of follow us here, can you give us like a really, really abbreviated version of what's really on your credit report? The report itself, what is it?
Yeah, the report itself is it should be, right? And you'll understand why I say should. It should be your name, your current address, any previous address, probably a partial. Most of the time it's partial. Last 4 digits of your social, your employment, your phone number, and then any account that is currently or was, or depending, open, active, charged off, repoed, like anything from that period of time should be on there. Inquiries, bankruptcies will show up there. Liens and judgments won't on any of the main bureaus for whatever reason. But if you went to a lender, got a hard inquiry, they'll find it. So don't think you're out of the loop on that one, because it's happened a bunch of times, and I warned people of that. Yeah, inquiries. Oh, every creditor that's on there, that's open and active, their name, their address, their phone number, and the same thing with the inquiries, their name, address, and phone number. Now, why I say should be on that data, because there's a lot of errors on credit reports. So your name could be wrong. It could be spelled wrong. Mm. You could have an address on there that's not yours. You could have old phone numbers. So in other words, if and at some point of time, all that kind of base information that doesn't really affect your report, name, address, and all that, it's only on there because you applied for some type of credit, and the person that you gave it to, or that creditor who's running that app, that's how it got entered into the system.
So it's all sitting there, whether it's correct or incorrect, and you can help people remove stuff that was incorrect or maybe didn't apply.
Yeah, and and most people, I'll probably be the only person in the industry to tell you this, like, you can do it yourself too. You know what I mean? Like, we're not just like you can change the oil in your car, the brakes on your car, do your own taxes. You can fix your own credit,
Well, it's been a good show.
Yeah,
Thanks
right?
for your...
But no, full disclosure, like all that stuff, all that address stuff, like that's the easiest stuff to remove, because it doesn't matter. Like, you could either do it online or call and say, hey, I don't live here anymore. Like, that's not my phone number. I don't work here. And a lot of times online, you just click it and it just goes away.
That's good to know. I'm sure a lot of people listening did not know that.
Yeah, it's good to clean up.
Yeah.
Because if there are errors, I'll give you an example, and I don't want to draw us into here too long here, but my dad and I have the same last name, and he had, I should say, an insurance claim on an automobile one time. Even though it doesn't show up on the 3 main bureaus, it shows up in LexisNexis and other data furnishers. Well, when I went to go get insurance, and I'm still in my 20s, and you know how expensive auto insurance is in your 20s, they gave me this astronomical rate. And I said, well, what's going on here? It's, oh, well, you had a claim filed on this date and this blue GMC on this. I said, I don't own blue GMC. I said, but my dad does. And he has the same name as me. I said, you might want to look into that. Like, let's fix this here. And then they fixed it. And man, what a dramatic change in what my insurance rate was. Probably a couple $1,000s because of it. But you got to remember, and I'll close with this on that credit report stuff, is these guys are private companies. They're not tied to the government or anything. They're worldwide. They're just data furnishers. So you're dealing worldwide with billions of people and billions of data. So you don't think they're going to be sloppy and make mistakes? 80% of credit reports, whether it's good data or even bad data, have some type of error on them.
So check up on your own stuff.
Absolutely.
Make sure your report card's good, because there might be a mistake somewhere.
Every 30 days.
And there's a way you can get a free annual credit report.
You actually get it weekly from them because
weekly,
of COVID.
Okay.
Yeah, from freeannualcreditreport.com. You can even go directly to the bureaus if you want, to Experian, Equifax, and TransUnion. Experian has their own app. Credit Karma, even, it's a different subject, but at least you have something with TransUnion and Equifax from an app standpoint. So, yeah.
That's good. Stay up on it.
Mm-hmm.
One last question for you. How can you quickly improve your score if you're looking to buy a property, whether it be investment property, something, and you have a few dings and a small credit issue? How could you quickly improve your score? What's the actions that you could take that makes the biggest swing?
Well, number one, see if it actually is an error, right? So if you have, or make sure it's your account. So like I just made that example of my dad, right? make sure like, hey, well, I have a medical collection on here. Well, I didn't go to the hospital. Like, make sure that's actually your account, because you can obviously, through Fair Credit Reporting laws, through the Fair Credit Reporting Act, actually get that removed, right? Like, it's up to them to prove it. So make sure everything on your credit report is factual. Like, that's number one. Number two, if you have credit card debt, again, I said it's 30% of your credit score. Even every 10% of usage is a lot, but ideally make sure you get that utilization. I always recommend under 10%, you're going to have the maximum points back on that. And then number three, if you need a point increase right away, even if your score is pretty decent, again, going back to credit cards, see if you have somebody, family, close friend that has even better credit than you, and just get an authorized trade line on there from them, become an authorized user, and then kind of hack your score that way. Those are always the quickest, but I say from a quick standpoint, usually 30 days, like that. Those are the three top things right there.
That's awesome. Well, Dave, thanks so much for your time. I really appreciate you coming out. Everybody, this is Dave Burgio from Trifecta Credit Solutions again. Thanks for joining REI Partners. My name is Matt Morrow. First time officially on the show here, so it's good to see everybody. And I hope to have you on again, Dave. This has been fantastic.
Yeah, Matt, thank you very much. I appreciate it.
Keep it classy.